For you, it's wanting to write the life insurance, say, beef up your numbers there and get to know your tuitions going.
Something that I did is that I did kind of like, again, and it was great sales pitch statement that it turned into a reality was, he owns a landscaping business. So I did go through, the, the incentives and using that as a write-off. And then he came and he said, well, how come you never told me I could do this? So then he's like, you'll be look into it. He's like, because then I'll start a different type of plan with you guys so that I could, take full benefits of it.
Yeah, how fascinating. That's a great takeaway from this exercise, right? I know that when I was new to insurance and owning my agency, I would ask as many friends that were willing to do this with me as possible. Because number one, they're just trying to be a friend and help you practice, your new craft or your new skill set. But number two, it's really eye-opening for them, right? They're gonna actually see that they might not have nearly enough in place through their employer or whatever they set and forgot about 5-10 years ago. Oftentimes it has nothing to do with their actual needs. So taking them through this is really powerful. So thank you guys for giving us some feedback. Give me a raised hand if anyone feels like you need more practice going through this exercise. You're not quite feeling like you can get in front of a client just yet and walk through this. You're all ready to go? Jimmy could use some practice. All right, so just Jimmy, I guess. So normally at this point, I'd say, hey guys, use more practice, and we usually have a ton of hands. And I would say, Jimmy, go ahead and get with Steven, get with Bill, do some practice on the side. You guys can help each other out here. So we could all use more practice. I've done this for years, and I can probably use some more practice there. All right. So I'm going to hand things back over to the fantastic Nicole Good. We'll move forward.
Thank you so much, Carol. So now that we've seen role play, let's talk about how please share those underwriting results and how to help those clients decide which product is going to be right for them. So you submitted the pre-approval application, you sent them home with your life insurance number worksheet. They filled out the numbers for that part 2 section to figure out if they need term, firm term, or whole life. So now let's talk about getting those underwriting results back. Now, the course that you took on your web-based training for policy placement did mention some key tips when sharing the results from underwriting. So I want to hear from you, for those of you that did take that web-based training, what key takeaways did you get from that training? Someone share with the class. What did you learn from it? What was the key thing that you took?
To always just bring it back to why they started the process in the first place and why they believed in it once we went through it. So if there's a negative underwriting or it gets declined, just to keep them as confident as you can about why they were doing it in the first place and go back into front of that. That might work.
You're absolutely right. So we want to remember to stay positive. So reinforce that reason for the life insurance and maintain those positive results. So if the results were different than they expected, like it came back worse with a higher rating, say, hey, congratulations, you qualified for life insurance. You just got to remember to stay on the positive side. Don't default to the price point. We just got to remember that the reason that they're getting the life insurance in the first place. So excellent job on that. So now we want to look at discussing those product options. They have filled out the part 2 of your life insurance number. What are some things that you could discuss with them when you are discussing those product options? Go ahead, Bill.
Pivot to the brokerage options. Guess they don't qualify for the rate or the decline.
Right. If they are declined, you can pivot to brokerage options. But let's assume that they did qualify. How would you sit down with them now to discuss what options are available?
I mean, are you saying they came back with a different rating, like a
No, it came back approved. They didn't get declined, so we don't have to utilize brokerage. How would you sit down and talk about their product options with them?
Well, I'm not sure about that. I guess I would depend on his whole life or term life or a combination of term perm and then see what best fits their needs and go from there.
Yeah, absolutely. So you could talk about the differences between the firm, term, whole life. Is there any kind of tools that you would use, such as an illustration, for example?
Yes, you definitely have to have an illustration
Right. So that is what we want to
and
do.
no writing on it.
No writing on those illustrations. So lead with that illustration, build it out based off of their numbers in the part 2 of the year life insurance number. And we want to differentiate between the term and the whole life and that index universal life, if that's going to be an option for them, if that best fits their need, based off of the answers that came back with them. So using the life insurance brochures and those illustrations are essential. And I know that Kim is going to do an amazing job walking us through an example illustration in the second half of our class today. Those illustrations beautifully demonstrate how it's going to best work for the needs of the client. Now, since we reviewed what you learned from the policy placement, let's go ahead and practice some different scenarios involving sharing those underwriting results and discussing those product options. So I'm going to share a few examples one at a time. And for each example, please explain the situation to me as if I were the client, using the best practices that you've learned so far. So here's the first one. The first one is the application was accepted, but me as the client, I was put into a rating D. So I want to hear from you. How would you talk to me about my underwriting result coming back as a rating D? Go ahead, Christy.
Probably just focusing on that at least they qualified. Focusing on that at least they qualified. There's some people that don't, so you at least have the option to get life insurance.
Yes, we want to remember to stay positive. I qualified. We want to focus on the reason why I have the life insurance in the first place. So excellent. We still qualify. That's great. All right, next situation. The application was declined for medical reasons, such as those doctor records that came back. How would you talk to me about this one? Phil touched on this a moment ago. Go ahead, Stacey.
And just let them know that we can then still go through brokerage.
Yes, we do want to let them know that they can still go to brokerage. Awesome, excellent job. They could say, yep, unfortunately, your application was declined, and you can request from your doctor the reason for the declination, but we do have some options available through our brokerage department. With your permission, I'd like to go ahead and discuss these options with you. All right, last scenario, or not last one, sorry. The application was accepted for one person in a relationship. So one of the, like the spouse got approved, but the other person did not. And you're working with both of these people. How would you tackle this situation? I know one person has some. Stacey, go ahead.
So in that training, it said something about letting know that, you know, maybe in a year, we can try it again. But I didn't really understand that too, because it's like, if they were declined maybe for like some health reasons or something, they're probably not gonna qualify in a year because their health isn't gonna get any better. So I was kind of confused on that one. Like what?
There's a lot of different reasons why a policy could be declined.
Okay,
It could be something as minute as a type of prescription medication, which indicated one type of illness. So let's say someone has tinnitus, but the medication that they're on reflects mental health issues, but it's used for tinnitus. Those kinds of things could be reevaluated if they are no longer on the medication. Does that make sense?
yeah,
Go ahead, Kim.
I guess, you know, again, you could probably go to the brokerage then I guess for the other spouse.
Yes.
Yeah, so this is something that happens a lot. You know, someone could be declined for, like Nicole said, a number of reasons. One thing that I found to be really effective is to ask a lot of questions back to the underwriter that worked on my case. Specifically trying to get to the bottom of okay, when can we try again? And is there a time that we can reapply? Because oftentimes that's gonna lead to more information for you, as in, they could just be seeing that there's a new diagnosis for this client and they want to see some more time removed from that. And so sometimes it's as simple as a year or two, and sometimes it's like 5 years. So you just want to work closely with your underwriter, going through these case by case, find out what your options really are. And then, of course, there's always brokerage at the end of that. But I would definitely lean into the underwriter at that time.
But yeah, Stacy, to your point, absolutely highlight, hey, congratulations to spouse one, you got approved. Unfortunately for your significant other, it was declined, and if you would like to know the reasons for the declination, you can get in contact with your primary care physician, and they can let you know those reasons. But we do have some additional options for you through brokerage. So talking to them about those brokerage options would be the best fit. All right, next slide. The application has additional medical underwriting requirements to complete. So some things popped up that were not expected or anticipated. How would you have this conversation with me?
Reading the thing.
Go ahead, Stacy.
Don't they get notified of that as well, to, or is it just, or to then fill out or to provide?
So they won't get notified of it. That, remember with the case manager yesterday, he had indicated, Andreas had indicated that if additional medical requirements are going to be needed on a life policy that you submitted, you're going to be notified via
Oh,
the communications check.
That's.
And they'll say, hey, we ran a script check. Let's say it was a simplified. It should go through automatically. But when they ran a script check, some medications popped up. So now they need some additional medical requirements in order to complete that application. Think of that as the scenario that we're in. So now they have to run blood and urine and another physical examination, which was not initially expected. So how would you talk to me about that?
So I just let them know that we need, that obviously we need that, additional information, and well, I don't really know, so they're not gonna get notified? How do I tell them what to do? I don't know, pick someone else.
Okay. Christy, your hand's up. Go ahead.
So in that situation, just letting them know, hey, we need additional information, and we need to go, directly to your provider. So I need to sign this release. They're usually pretty good about it.
So not necessarily always going directly to their provider. If additional medical requirements are needed, that goes out to exam one. So that would have to be ordered through our underwriting department. And
Right.
they would just call them and let them know, say, hey, some additional medical requirements popped up. They need to run some blood and urine analysis. And exam one's going to be reaching out to you to get that scheduled. Just be on the lookout for this phone call within the next 24 to 48 hours so that you can go ahead and get that done promptly and as quickly as possible. We just want to make sure that your policy is the best fit for you and you're paying the premiums that are supposed to be paid. Go ahead, Kim.
Yeah, this just goes back to that managing expectations up front. Like, how did you position this when you took your application? If you said, oh yeah, for sure, it's gonna go accelerated, I'll let you know when it's approved, you're setting up for a really bad conversation, right? Because it's more likely that questions will pop up from the underwriter, or there will be a need for an exam. So you could always say something to the effect of, thank you for your application. I'll be in touch with you in the next few days for some next steps when I hear back. Or there, I'll let you know when I hear if there's going to be an exam. I'll help you take care of that as well. Don't have to worry about that. I'll be in touch with you. The most important thing is just letting them know that you're going to be on top of it. And I'm going back to, I think Stacy may have said, like, how do I know? You're going to get notified by our department that there's more steps to complete. So we'll get notified immediately. You'll be able to take that, like, okay, we need to get, this form signed by your doctor. We need to get this question answered, something like that. So.
Just let them know that when these additional medical underwriting requirements pop up, that you're there to help them get it set up to make the process easier and smoother. And Kim is absolutely right. Setting those expectations up front, like, hey, Most of the time these go through without any additional issues, but occasionally they do come back and say that they need some additional medical requirements. Just be prepared for that, just in case. But I'm here to help you with the process. So you could just let them know that in advance to avoid those awkward conversations as Kim mentioned. All right, the application has been selected to complete full underwriting instead of accelerated, and we kind of touched on this. Who wants to tackle this one? Pretty much just did it. I have faith you guys can do this. Go ahead, Ari.
I think it's just a fear of receiving that email and saying that it's been there, because it's happened to me in the past, and as long as I've been communicative to the client and explained the process prior that could be something that could happen, they were completely fine with it.
Yeah, most of the time you won't get a lot of pushback. So you can also tell them, hey, when we met the first time, I did say that sometimes everything will look good, but we still need to complete some additional steps. And it looks like your application has been selected to complete our full traditional underwriting requirements. And the reason for this has really nothing to do with you or the information that you provided. This is going to allow the home office to ensure that the accelerated is working as it should and that you're getting the best rate possible. So good job on that one. I apologize. I am a little bit under the weather. So Kim is now going to walk us through setting up beneficiaries.
Awesome. All right, so as Nicole mentioned earlier, there was some pre-work for this that you may have already gone through. So hopefully we're all up to speed. If not, shouldn't be too crazy for you. So types of beneficiaries. Go ahead and use the chat for me right now and tell me one type of beneficiary that you learned from the beneficiaries course or that you've heard of before. What do you think? Who would be the beneficiary of a life insurance policy?
Spouse.
So who? Okay. Spouse, definitely. Spouse and kids. Whoever they choose. There we go. Personal trust, estate. Business partners, yep. Siblings, business owners. Some of those buy-sell agreements out there, absolutely. So, as you can see, there are a ton of beneficiaries out there. People being the most common beneficiary type, right? But I also heard trust and wills, right? There's a great way to leave assets, among other things, to your beneficiaries in the time of your death. And it gives really great flexibility to people. They have one of these set up there. There's also companies. I heard business partner in there. So helping your business owners figure out what's going to happen to their business when they are no longer here to run it. Right? Do they have a key employee or a business partner? You hear different stories about when people don't have this in place for a plan, and then it goes to perhaps a spouse that has nothing to do with the business and no interest in continuing it. And that can be a heartbreaking thing for people that want that business to continue, like the employees that are paid by that business, right? So having a plan in place. There's also the insured's estate. So the same thing as will, right? So the estate can happen. But what's the problem with just allowing it to be your estate? Anyone issue with just letting things go to the estate? Bill.
Will there be a delay in getting the money? It goes directly to you, money right away. Within a state, it could be 6 months, 2 years.
That's right. That's right. You want to avoid that probate, right? You don't want to go into a probate situation where you're going through all the motions and wait for your payout there. Okay, so let's talk about primary and secondary beneficiaries now. Does anyone know the key difference here? It's pretty obvious, but let's just, for those of us that are brand new to life insurance, I think it's good to level set here to build a foundation of this next part we're going to talk through. So a primary beneficiary would be, of course, who's primarily going to get the policy death benefit. So why do we need to list a secondary? See some typing, lots of typing. If the person is deceased, right? Absolutely. Yeah. Okay, so yeah, if you are in a car accident with your spouse and they're the only one listed on that policy, but you have children and debt, things that are, you're gonna need to be handled after you pass away, but it's you and your beneficiary that pass away, then it's gonna go to what? That probate again, right? That estate is gonna default to that. So you wanna make sure you've got a plan in place and have some secondary beneficiaries listed. There's the option to several secondary beneficiaries. So of course, that one was a pretty simple one, but I do have another question for you. Nicole.
I was just gonna elaborate a little bit on this. When you are filling out the applications and they determine who they want their primary and secondary beneficiary to be, you can allocate percentages. You just have to write it out and specify how much of a death benefit percentage needs to go to multiple primary beneficiaries. So if there are someone that has 4 children, each of them get 25%, or they favor one kid and one gets 50 and the rest get the other 50% divided equally among them. You can write those percentages out and distribute it according to how the client wants.
Thank you, Nicole. Absolutely. Good call out there. So talk to me a little bit, you guys. Have you ever heard of a contingent owner for a life insurance policy? Go ahead and give me a raised hand if you've ever heard of a contingent owner. Okay. Steven's typing. I'm not gonna raise my hand. Vincent, thank you. Hi. Can you tell me?
Can I say what it is? No. Have I heard
That's
of it?
okay. But you've heard of it before, absolutely. So, well, I'll just go ahead and like talk through it. So this is important because if the owner is different than the insured, if the owner of the policy dies, a contingent owner can then define who owns the policy. So they can help manage that policy, make decisions of that policy. It's really important, especially for child policies, right? Those juvenile policies to which maybe one parent had set it all up, but then if that parent passes away and the other parent was never listed as an owner on the policy, that could be a real issue for the insurance company to talk with them and help them manage that policy for the child. Or it could be for another situation, maybe perhaps again, going back to the business partners and things of that nature. Nicole.
Another example of putting a contingent on our own policy is I have 2 daughters and I took out life insurance policies, whole life insurance policies on both my girls. And both of them each have the GIO, but I am the owner and the payer of those policies. And because they're 20 days, so they'll be paid off in 20 years. My daughter is the insured and now she's 18 years old. So she's considered a legal adult, but if I passed away, and let's say that the policies were completely paid off in the 20 years, if I passed away and there's no premium no longer needed, she can then become the contingent owner. If I list her as the contingent owner, if I died and something happened to me, she now controls who her beneficiaries are on her life policy.
Yes, good call out there, Nicole. Thank you for elaborating. And good call too on the juvenile policies. I also have life policies on my children, and it has nothing to do with the death benefit. It has everything to do with giving them that gift of the GIO, that guaranteed insurance option, so that no matter what happens to my children at any point in their lives, should they become uninsurable through a diagnosis or a health issue, or maybe my son gets crazy in his 20s and he's just all these DUIs and now he cannot even qualify for a life policy because of too much bad behavior, he will already have this base policy that he can grow upon and never have to prove insurability. Okay, so that's the gift of the GIO, and plus the cash value that grows over the term of our life. I really like that part of it. So, anyways, we talk all day long about juvenile policies, but I think they're important. So, as you learned in the beneficiary course, and if you haven't taken it, I highly recommend that you get in there and do take it. There could be some issues come claim time with beneficiaries. So something as simple as a name change or relationship status change can cause a death benefit to go to the estate. Okay, this happens all the time with people that get remarried and forget to update their beneficiaries. It really does. You forget about the policy that you had, and guess what? Your new grieving spouse is really upset when they find out that they don't have any claim to your life insurance policy, and it's going to your ex-wife or your ex-husband. So it's really important to, in all of your meetings with clients, to be on top of the beneficiary conversation, making sure they are still accurate. So as part of your reviews, of course, doing this, but also there's an easy way to get a list of all of the policy beneficiaries that you have in your book. It's called the Life Book of Business Dashboard. And this dashboard allows you to identify opportunities within your life book of business. It also allows you to easily pull up policy beneficiaries and even then export them out to an Excel file. So there's a really great video, you guys, out there on Level Up. And this will go through the beneficiary review, and you may find this really helpful. So I would recommend that you watch that. And I'll drop the link for that, or maybe Nicole will, in the chat here in a few minutes. But I do want to mention that there's a really great job aid that'll help you get started with the dashboard as well. So you can find that in our link that we drop. And pretty soon here, we're going to get into a very fun Jeopardy style life game that Nicole mentioned earlier. So all of the resources that we've covered so far can be found in our Level Up site that Nicole's dropping right now. So I would just go ahead and save that there. Any questions before we move into our life game? Nicole, anything else that you would add?
No, not at this time. I'm just excited to get into our game.
I know, it's Friday. Playing the game kind of sounds like a treat, right?
Right.
All right, so I do have one bonus topic for you. Nicole, do you want me to take it, or do you want to take this one?
You done? Okay. All right, everyone. So let's talk about the trackers that are available to you. Now, I do want to highlight the life trackers available. There is one for new business and one for serviced business. Now, the Life New Business Tracker allows you a holistic visual on the status of any given new business case. And this dashboard gives immediate insight on what's needed and the status of your current cases. So you can even see the status of any statement of health and delivery here, as well as which which is going to be top of mind. And it's going to help you stay in the right place, helps you keep track of those policies, so that you can stay in contact with your clients and let them know, hey, this is what we need. This is where your policy is currently at. Its counterpart, the Life Policy Services Tracker, allows a whole new level of insight into what's going on. So with this dashboard, you can see the status of all of your service requests. So if you're making policy changes, if it's awaiting review, that means that home office has not yet looked at it. If the status is pending agent response, then that means the home office is waiting for you and those additional steps that are going to need to come from your office. Now, if the status is pending in home office, then we, I apologize, are needing to do something on our end in order to move it forward. So you can filter by the date, the policy number, or even the type of request. There is a second tab called Completed, and that shows all in-force requests that have already been processed. So you can access this report and other life tracker dashboards from the life policy tracker landing page, and it's gonna provide you a lot of different ways to track that life business. And the link should be in the resource document for you. 1 second. I'll pull that up right now. Paste the link, Tableau reports. As trainers, Kim and I don't have access to it. This should work individually for the agent. Everyone good to go? Give me a thumbs up if you receive that. Excellent. All right, give me a high five. All right. Now we have to write a game to help you to practice everything that we've gone over so far. Now, everyone is going to be assigned to 2 teams, and I'm going to get my teams posted in the chat box for you now. Everyone do that. The team 1 is Adam, Ari, Jeanette, Christy, Megan, and Steven. Team 2 is Andrew, Bill, Jimmy, Marilyn, Stacy, and Vincent. The way that we are going to play this game, I'm going to have Adam go against Andrew for the first round. Now, whoever hits the raise hand button first is the person that I'm going to call on to answer the question. If the person cannot answer that question, then it's going to automatically default to the other team who didn't raise their hand. I will then go down the list in the order that it's displayed in the team. And if neither person can answer it, I'm going to open it up to the whole floor. Just make sure that you wait until I completely finish answering the question before you do raise your hand. Allow me to at least finish it. Are there any questions in regard to this? I do need somebody that will keep track of the score for me. Who wants to be scorekeeper? Steven, you're going to keep score for us?
Awesome. I like that Megan and Marilyn's name are bolded. Maybe they're the team captains? For each.
No.
All right.
Are there any questions before we move forward?
Vincent's typing, so I'm not certain if he's got a question or not.
All right, Steven, you're our scorekeeper, correct?
Ma'am, yes.
Okay, awesome. So Kim is now going to share her screen to load up the game. We are going to start with the very first question, which is in the top left. And it will be starting the conversation. So first up, we're going to have Adam versus Andrew. So Adam versus Andrew.
All
Start
right.
the conversation for 100. Dime stands for blank.
Oh.
Go ahead.
Debt, income, mortgage, and education.
Correct. So we have $100 going to Adam on team blank.
Awesome job.
All right,
To game board.
Adam, since you have gotten the correct response, you get to select our next category.
But education and underwriting for would be helpful.
Education and underwriting for 300. When binding a life application, how much premium do you have to collect? This is for Ari and Bill. Ari,
All right.
I think it's first month's baby.
looking for something a little bit different, but you're very close. So I'm gonna default to Bill, see if he can get it.
I was gonna say, first month myself.
So
Said it first, Bill.
it's another M word, not month. All right, I'm gonna open it up to the rest of the floor. All right, I saw Stacy's hand go up. The word modal, one mode of premium, so it's not 1 month. So if they are paying their premiums in full and that is their mode of premium, we have to collect that full mode of premium, not just 1 month. So you two were very close, but Stacy got it. So Stacy is with team 2. So that means 300 points to team 2. And Stacy, since you got the correct answer, could you please select our next category? And if you guys could go ahead and lower your hands for me so that we can set up the next one. And this one is going to be for Jeanette and Jimmy.
I can't see the choices.
Hey, Kim. We can't see the board.
You can't see the board right now? Oh, sorry. I was trying to lower their hands for them.
That's okay.
All right, here you go.
Let's do preliminary education and underwriting for 400.
Preliminary education and underwriting for 400. Who do you call if you have questions on a life application? This is for Jeanette and Jimmy. Jimmy, saw your hand pop up.
I believe it's the Western Team Underwriting, right?
Oh, it's I'm sorry.
Ah,
All right, let's see if Jeanette, let's default to you. Do you know the answer?
I was gonna say underwriting wholesale, but I think that's not right.
It is a department of underwriting, but I'm looking for something specific. All right, I'm gonna open it up to the rest of the floor. I saw Ari's hand pop up. Ari, go ahead.
Case management.
The lifescape managers, that is correct. So team 1 gets 400 points. Ari, you selected the correct response. So please select our next category for Christy and Marilyn.
We do placement for 500.
Policy placement for 500. I can't. Can you go ahead and lower your hand for me though too? All right, Christy and Marilyn, what is the difference between dividends and indexed credit in relation to life insurance?
A little bit more difficult at the 500 level.
Christy and Marilyn. Going once? Going twice? Ah, Christy, got it.
Not overly confident on this one, but, isn't one of them based off like stock market, when it fluctuates?
Yes, the index credit is based off of the index of the S&P 500 index, but that's only half of it. So we're looking for the complete answer. All right, let's go ahead and go with Adam. Adam is on team 1.
Dividends are based off company performance and company profits, they're not guaranteed, and like she said, the index credit's based on the S&P 500 performance.
Correct. So Adam, thank you. You got both done. The 500 for team 1. Adam, you got the correct response. Please select our next category for Megan and Stacy.
Policy placement 400.
400.
What writer promises the right to purchase additional life insurance protection every 3 years without additional medical requirements? Stacy.
The additional data. Oh, no, we're looking for oh God, I have the wrong answer.
Okay, so I'm gonna defer to Megan. Megan, do you know this one? Going what? Going twice? I thought Adam's hand pop up. Go ahead, Adam.
A guaranteed insurability option.
That is correct. The GIO that Kim and I were referring to on the children. Yes, that is correct. The 400 to team 1. Adam, since you got the correct response, please select the next category for Stephen and Vincent.
Going up the line, policy placement 300.
Policy placement for 300. If our company pays out a dividend and you set an IDF allocation of 100%, you could potentially blank your dividend. Even in Vincent. Vincent, go ahead.
No, that's right, and I know it's not right, so. I'm gonna just say double the dividend.
Double your dividend, that is correct.
That's great.
I had a different verbiage to it when they put it, that's why I couldn't remember what that exactly.
Potentially double your dividend.
Yeah,
Right,
okay,
potentially.
Help.
It's not promised, but the potential is there. So, all right, we have $300 to Team 2 for Vincent. Vincent, please select our next category for Adam and Andrew.
Let's do the starting the conversation without.
Starting a conversation for 500. You're working with a married couple, both of whom are retired and their children are financially independent. What is one probing question that you could use? Adam and Andrew. Andrew, sorry.
Would you like to leave a legacy for your children?
Perfect.
Pretty
So, perfect. $500 for Andrew on Team 2. Andrew, please select our next category for Ari and Phil.
We'll do, starting the conversation 200.
What are two advantages of in-book prospecting over out-of-book prospecting? Ari. Oh, wait. No, Phil deals with that first.
They're already a customer and you know their background.
That is correct. They are already a customer, you know their background. What is the second one? So that's one. They're already your customer and they know you. So that's one. I'm looking for two.
And use that.
Should I give it to him, Kim?
Yeah, I mean, technically, it's two different phrases. They're along the same lines, but I think we could give it to him.
I think we'll give it to you too. So I was looking for Bill's retention. That's another advantage, but we'll go ahead and give you that. So 200 for Bill on Team 2. Bill, please go ahead and select our next category for Jeanette and Jimmy.
Let's do 400, start the conversation.
Start a conversation for 400. What are 3 life events that you could leverage to transition to the life conversation? Life event. Jeanette and Jimmy. Jimmy.
New marriage, new job,
JJ Jones.
mortgage mortgage,
Bye.
buying a home.
Good job. So $400 to Jimmy on Team 2. Jimmy, if you could please select our next category for Christy and Marilyn.
Let's go, preliminary, education and underwriting for 500.
How often should you check your Life Suite pending new business policy tracker? Christy.
Daily?
Correct. Every day. So $500 to Christy on Team 1. Now, Christy, if you could please select our next category for Megan and Stacy.
Starting the conversation 300.
What are 2 ways to prospect out of book? Megan and Stacy.
Two ways to prospect.
Megan?
One is referral method and the other is utilizing I think it was hearsay, maybe.
Yeah.
Yeah, social media marketing.
Content hearsay and the referrals, asking for those referrals on your agenda. Excellent job. So we have Megan on Team 1. So we will give her Team 1
$300.
$300. So if you could please select the next category for Stephen and Vincent.
policy placement, 200.
What are two resources or tools that you can use to help educate your clients on term and whole life before or after underwriting? Eden and Vincent.
Do, 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 do.
Going once,
Lost on this.
going twice,
Okay,
open it up to the whole floor.
all right, thank
I
you.
thought Adam can shoot up first.
An illustration as well as your life insurance number.
Not, one is definitely accurate. Your life insurance number, yeah, I think you can use that too. Go ahead, I'll give that to you.
I
The
think
other
they're
one is
both
also the
accurate.
diagram. The
Okay.
diagram that we done, so I'm gonna go ahead and give that to you, so yes. 200 for Adam on team 1. Adam, if you could please select our next category for yourself and Andrew.
Policy placement, 1 of.
What options can you present to the client if their application is declined? Adam, go ahead.
Brokerage options,
That is correct. So $100 to team 1. Adam, if you could please select our next category for Ari and Phil.
patient and underwriting, for 200.
For simplified underwriting applications, when can you collect money from the client or prospect? Bill, your hand was up first. Go ahead.
Immediately?
That is not correct. So I'm
Ari
going
can
to defer
see.
to Ari.
At the, binding signing of application.
Oh, that's not what we're looking for. You guys can lower your hands. I'm gonna go ahead and open it up to the rest of the floor. I saw Andrew's hand shoot up.
Once policy is approved by underwriting.
Once that policy is approved. That is correct. So simplified is the one that we cannot bind and collect that one motor premium on. We have to wait until it's approved from underwriting. So $200 for team 2. If you could please select our next category, it is for, I think it's Jeanette and Jimmy. That's where we're at, correct?
We've got one category left.
What types of underwriting can be bound? I think I may have just given away. Jeanette, go ahead.
Is it accelerated?
Accelerated is one. Absolutely. There's 2 of them.
With more.
All right, so I'm gonna go to Jimmy.
Accelerated and simplified?
All right, so now I'm gonna open it up to the whole floor. Andrew, go ahead.
Bold would be the other one.
And what was the first one?
Oh,
No, sorry.
Yeah, accelerated and full. That is correct. So $100 for Andrew on team 2. Now we are entering into our final check. So I would like to know from Stephen, where are we currently at?
Team 1 with 2,600 and team 2 with 2,000.
Team 1, do you want to place your wages on the final round and team 2? What does team 1 want to wage on this final round?
I will say that more often than these classes, people go all in.
All or nothing.
Uh,
Is that what you guys wanna do? All or nothing?
Full send.
Well done. Christie has spoken.
All right.
What would you like to wage? All in? Leave 100.
That sounds funny. Leave 100 just in case.
All right, so it sounds like both teams are gonna go all in. All right, let's go ahead and enter into our final round. Whoever raises their hand first, I will call upon you. Why is it a bad idea to list the insured's estate? I saw that hand pop up first.
Probably.
Probate, that is
Yeah.
correct, because the process is lengthy and, they would have to wait a long time, that is correct, so. All right, team one. Team one. For the win, congratulations, you are all winners. Give it a round of applause. I hope you all have enjoyed our game. Because now we are gonna do a quick break. Is that accurate, Kim? So we can reload our part two.
I think that'd be great. And then role play the placement appointment, right? So I'm gonna jump ahead here to the agenda. We're gonna start this part of the session digging into what we are going to be doing during this session. We'll go through the first one together and demo presenting an illustration. So I'll get to go through my Stephen McGuire life illustration as if I was working with Stephen. And you'll get to see that. And then we'll go to wrapping up at the end after some case study practice. Any questions as we kick this part off here? Did you have a good few minutes break? Refill your waters, refill your coffees, do some push-ups, jumping jacks. All right. Let's jump into our first case study. So this one we'll do together. The purpose of these case studies is really to get to the learner excited, about all of us to get excited about how we're going to take clients through this part of the process, right? So you've learned all the different components of the life sales process, and now we're going to go through the case studies. So assume that you're preparing for post underwriting. Okay, so assume it's already gone through the underwriting process. You've already met with the client a few different times. So you're gonna have to consider the results. Okay. So during your preparation, one thing that you might want to do is prepare an illustration to present to the client. So in real life, that's what you'll be doing all the time. So I'm going to show you a scenario with your life insurance number and the underwriting result. And I want you to read through the scenario and the information and then answer the 3 questions that you see on the slide. So again, we're going to go through this first one together, and then later on you'll get the opportunity to do another one in a group. Okay. So here, these are what you need to answer. What type of insurance could work best for the client? What additional options might be applicable? And what tools or resources would you want to be using to work with your clients? Okay, so those are the 3 things I want you thinking about and prepared to answer. Type of insurance, additional riders or options, tools and resources. Here we go. So read through this right here for Selena and Stephen. Okay, I'll let you read this over for a few minutes and start thinking about, again, the type of insurance, potential options, sales tools you might want to be using. I'll give you about 4 minutes to read this over, and then I'll ask Mrs. Volunteers for what you're thinking.
mortgage. Right.
I'm gonna give about one more minute and then we'll start talking through some of your thoughts. Right, so in a second, I want some volunteers, just give me some highlights of what you're thinking about for this family. There's really, again, no right or wrong answer here. We know that in a real life situation, you would have more facts. We just really wanted you to be thinking about these key things that you'll be picking up on when making recommendations. Things like how long left to pay on their mortgage, right? How old are their kids? What does this family need? What type of options would really benefit this family? So who wants to give me a couple of different thoughts they had for the type of insurance they're going to recommend for Selena and Steven? Vincent.
Yeah, looking at this, one recommendation is education. They're planning on having children, they don't have right now. There's there's nothing that's set aside for any type of education for their kids that are potentially coming, which you're looking at kid 18 years minimum if they have one the very next day. There should be another at least 100 to 150,000 that's probably should be set aside for that. That should be placed in there, as well as the fact that if they do have kids, her income goes out the window. Yeah, he had to set at 350,000, 50% of over 10 years. I probably try to bump that up too as well, so we about $500,000. So I'm trying to put that on it. That'll be somewhere about, I guess, we're looking at about 2/3 or something like that to kind of adjust that on.
Okay.
Which one here?
Okay, so adding the education cost, keeping that up a little bit. Good thoughts there, Vincent. Thank you for sharing. I saw another hand up. Is that Jimmy?
Yeah, so I would also look at the mortgage protection and their legacy, either a whole life, and if they can't afford it, then jump over to a term policy.
Okay, showing a few different options there. Thank you. Megan, what are you thinking?
Based on the age, I do think the indexed universal life would probably be a really good option for them. And then also, a term with that, and I would probably stretch that to a 20-year term. But long-term goal with the index universal life due to their age.
Yeah, right on. Thank you for sharing and giving me your thoughts. Absolutely. Anyone else have a thought before I share my screen and go through an illustration for Stephen on some recommendations that we had made for him? I like the per term split idea, using the IUL with term split to make it a little bit more affordable. All right, so I'm going to go ahead and share my screen. I do have an illustration already ready for you. So within Navigator, of course, you go to the household folder to begin your illustration, but because of today being a demonstration, I already have this built out for you. So Nicole, I'm going to share my screen and I want you to go ahead and tell me when you can see Stephen's illustration.
I can see Stephen's illustration, but if you could zoom in, the font is really tiny.
Is it small? Okay. Let's see here. A little bit better, you guys?
Yeah.
Oop, too far. I think that's a little bit too far. See here. Sorry, having trouble with Zoom now. Can you guys see that okay? I must did not zoom in at all now.
It went smaller again, if you could increase the screen size.
Yeah. Trying to, it won't even click anymore for me. There we go.
I think in the bottom right-hand corner, there's magnifying glasses that you could hit.
Thank you. I've really made it mad now. I'm trying to play with the Zoom a little bit. In a second, I'm probably gonna zoom in a lot again. Okay, is that better?
That's perfect.
It's all over the place now. Okay, cool. So here we are, Stephen's whole life policy. I'm gonna stop sharing my face because it's hard for me to read through the illustration and I don't need you looking at me while I look down. So imagine Stephen has walked into my office. We have met a few different times before. So I'm gonna say, Stephen, thank you so much for meeting with me again to discuss your life insurance needs. I first want to go back over your life insurance number with you to make sure that nothing has changed. So we have your total need today at $582,000. Does that still sound good? Can we say yes? And I'll move on to say, well, what I want to go over with you is what we call a firm term split, because you'll get to sample from both whole permanent life product and our term life. And I will show you why here in just a few moments. And if you're thinking, okay, Kim, this only shows a face amount like at 196,000, close to 200,000. You'd be right. This is part of the beauty of the perm term split. You can access perm insurance at a lower coverage while retaining term coverage for a period of time. Okay, so it helps keep the premium a little bit lower, but gives you that full death benefit overall. So we really do have $582,000 covering Stephen. Just the base part of the policy is that permanent plan at 196. Okay, so let's walk through this a little bit more. All right, so I'll be reading on here with Stephen. This will work for me. Sorry, for whatever reason, it's not scrolling down for me. Call. There we go. Okay. So on this page, I'd be sitting down with Stephen, and I'd say, going back to our prior discussion, Stephen, the coverage and the need that we talked about will cover you if you die too soon, if you live too long, if you become seriously ill, and here's the fun part, Stephen, if you need to access the money. You told me about a lot of fun dreams that you had, and I think this cash value in the policy is going to be a really great benefit to you and your family over time. So while you have that emergency fund, right now, this is for those opportunities in the future that we were talking about when we met before. Okay, so next I would move on. If my screen will ever let me do that for you. Come on. And this has never happened to me before, Nicole, or it won't move for me. There we go. Okay. So this page here, when I'm sitting down with Stephen, it's going to be a nice overview of the policy, and it gives the guaranteed value here and the non-guaranteed value. So as I'm talking about money, it's going to show you what the policy could grow to over time. So the guaranteed value, assuming the dividends are not great at all, shows that your policy will have a cash value of about $103,000 when you turn 65. This again is guaranteed. So that's really cool, Stephen. Assuming dividends pay out like they have been historically, you'll actually be a lot more close to 199-ish thousand at age 65. Okay, so this is going to be more probable to land somewhere in the middle of these two numbers, maybe closer to this value, but of course this is what is actually guaranteed. Okay, and as that number rises and you get to age 85, a good amount will actually still be here as well without paying any more into your policy, because as we mentioned, this is the life paid up at 65. So when you're 65 years old, this policy will continue to grow, but the premiums will stop. And I'll show you what that looks like here in just a few minutes. And so this is a nice overview of the accelerated death benefit. So this policy includes the terminal illness and the chronic illness. So both of these things are automatically included in here. We're not paying anything extra to have these. And whole life policies all come with these accelerated benefits if ever needed. So if you, Stephen, ever become chronically or terminally ill, this benefit can help pay for expenses related to your illness by advancing a portion of your death benefit to you while you're still alive. This is going to reduce or potentially eliminate the death benefit depending on what occurs and the policy value at the time. But this page has got some really great overview of what that could look like for you at those times. Of course, you could read through all this with your client, but I tend to not drain every page with the client. I don't want them to be so bored that they are losing interest with me. Sorry, these illustrations are full of a lot of great information, but they are, like I said, full. So if you talk through every page, might lose up, but definitely want to highlight some important things. Alright, so we talked about this already, included benefits. There's also the included index dividend feature, right? So we have allocated in this one, Stephen, 100%. That's gonna go into growing that dividend so that hopefully we could double your dividend when the index is performing well. Now, what I like about this page to walk through with my client is that talking about the optional benefits and riders that we can add here. Like I said, this is a per term split, guys. So we have added a 30-year term rider for Stephen. So this is where I would be sitting with him and I would explain on this page, you can see what the cost associated with the additional insurance for your need. So when we began this, we uncovered a need of $582,000. Your base policy was about $196,000. But we're gonna make up the balance difference of this with this 385 here, which is really only adding 38.56 monthly to your premium. Okay, so this is how for the next 30 years we have achieved his full need of the $582,000. But 30 years of this is on the rider that will fall off when he is 69 years old. Right? No, 59 years old. I'm sorry, he's 29. So in 30 years, he'll be 59 years old, and this will fall off, and so will the premium associated with it. Okay. But he'll still have this policy for the rest of his life with the life paid up 65, and he'll stop paying at age 65. The other piece of this that I would point out to Stephen is this disability waiver of premium benefit that I have also added to his policy. It's only $13 a month, as you can see, and this is going to be great because it's going to, like it says, waive the premium if he becomes totally disabled at any point before age 65. Okay, so any premiums that would be needing to be paid would stop, but he would still have to have his policy in force. Right. Of course, we talked about the GIO a few different times today. That's where you can find this policy. This was a child policy. I would definitely want to include that option. If he had children right now, like he wanted to add a child term rider on, he certainly could. Okay. So jumping ahead here, are there any questions so far, Nicole, in the chat? I'm not really looking at that right now.
There are currently no questions in the chat.
Thank you. Okay, so the index dividend feature, if you would like to allocate to this rider, which we have, it's going to increase that policy cash value, which will be tied to the market index. So of course, it allows you to go from 0% all the way to 100% of your non-guaranteed dividends based on the performance of the index. The benefit to you is if the index does really well, your policy receives more dividends. So how much more really depends on how well the index does. So right now, Country again will multiply dividends by 2 if the index is up at least 9% over the past year. If the index does poorly, it's possible that you may get a reduced dividend or again, no dividend at all. That is all not guaranteed, but this is a nice page to kind of go over with them and explain that. So you could, like we said earlier, potentially double your dividend or land somewhere in the middle. Okay, I also love this page with the historical look back of how the index has performed over the past, I believe it's 20 years. So looking here from 2004 all the way to 2023 here, we can see how it has performed over time and what the multiplier was here at Country based on the index at the time. All right. So here in 2006, we were at 13%. So we had 1.95% over here, nearly doubled that. In 2013, we did double. In 2009, we did double. So a lot of years where we did double the dividend for our clients here. So what I like about this when I'm talking with Stephen and any of my clients is just pointing out the obvious fact that the guaranteed values are all under the assumption that there's never any sort of, positive change in the index, which historically speaking is just not true, right? It's going to be landing somewhere in the middle and more likely closer to that non-guaranteed value, which we'll look at here in a second. Any questions on this, Nicole?
Ask most of the questions, because there one dividend option that's most popular, purchase more insurance, premium reduction, paid dividend. I can go ahead and say that option 4, where those dividends pay for purchase additional insurance, that's the default, so typically the most common one. Kim, do you have anything you wanted to add to that?
Yeah, that was gonna be my answer too. Most commonly, I saw my clients choosing option 4 to allow for that growth, just, continuing to increase their death benefit, increase their cash value over time. Good question. All right, so accessing the money, obviously there are ways to have policy withdrawals and policy loans. They are different, right? So part of the reason why we can say that you'll have peace of mind if the worst doesn't happen to you, because if the cash value of the policy will carry, we would talk about this earlier, but you have access to that cash value as the policy builds it. You have access to it through these withdrawals and loans. So the withdrawal makes sense after the policy has built up some of that cash value, and you don't need that total death benefit built up at that point. A withdrawal can be taken from the cash value of the policy, and that would be considered a partial surrender, as it's going to reduce the death benefit and it cannot be put back into the policy. That's the big difference there. The loan is the other way to utilize the policy's cash value. This one makes sense when you do not want to permanently reduce your death benefit. Okay, and so you would otherwise be taking out a loan from a traditional bank or another means of a lender. So as you can imagine, it's actually a lot more affordable to be taking out loans from yourself than from those big institutions out there. So the APR is going to be a whole lot lower, and you can pay yourself back to repay that loan balance, and that death benefit won't go down once you paid yourself back. So it's basically using yourself to be collateral over time, which is pretty neat. And I did have a lot of clients taking advantage of that. This can get really complicated quickly when you're talking with your clients. So my main takeaway for you is that you will have access to the cash value if the policy value is needed. It's there if you need it, but you don't have to do it. Okay. So I'll scroll down for me again.
Jeanette has a question. So does the interest rate change when taking out a policy loan?
I don't think it changes. I think that you'll know the interest rate up front. What it is, like I think trying to remember the difference between whole life and IUL. Do you remember? I think it was like a 3% for traditional whole life APR. Taking the loan out for yourself. That's typically what I saw for most of my clients was a 3%. But
I honestly don't know the answer to this question. I only had one client ever in the 6 years. They got a policy
Really?
loan from a
Okay.
policy. So I don't know the exact percentage of return. I'm sorry.
it's okay. I do know that on the IUL, what I thought that was pretty cool on that is once you have it for, I want to say 10 years, the first 10 years, I think it was like 1.5%. And then after 10 years, when you get to that 11th year, you could borrow for yourself for less than 1%. It was like 0.5%, I want to say. So I'm just saying it's a lot lower than the APRs you're going to see when you're talking about big bank. You're trying to get a loan from, JP Morgan Chase or another traditional lender. And you control it. Okay, so I like this page a lot. This is the narrative summary. This is going to have a nice overview of what we're doing here and what we put together. So again, back to that total death benefit of $582. The full total premium is $280. That's what we put together today. The makeup of it being that the base policy has a life pay of 65, that face amount that we started with at 196,427, adding about 227.80 to the monthly premium. Down here, you can see what the writer is doing. That adds that 385 for the next 30 years of death benefits for only 38.56 a month. That's amazing, right? The disability waiver premium adds that $13 here, and then you can see all of the other things that are added in here at no cost. So the index dividend feature, the terminal illness, and the chronic illness protection. So this is a nice one to walk through. All right, key terms, definitions, when you're going through with your client and anything comes up that you want to fully define, you have this here. All right, so coming into, so there's a lot of these tabular pages here that's going to give you a nice overview. So this one shows you from policy year 1 all the way down to 92. So you can see attained age 30, so he's 29, turning 30 here, all the way up to when he's 121 years old. Is Stephen going to live this long? Maybe not, but it's nice to see, just in case, what's going on here. What I really like is it shows right here that at age 65, Stephen, your annual contract premium, you know, it was $2,824 this year, because it has that whole life, you know, contract still built in. Before this, you can see where the term rider was here and dropped off at age 59, right? It was a 30-year term policy. So when that dropped off, the premium contract changed from 3,300 basically to 2,800. But then after that, look at this. As this continues to grow, even your premiums have stopped. So even when you live to age 100, you'll have this growing cash value, this growing death benefit, or now it's just a death benefit. But over here, that's the guarantees over here, right? Remember what I said earlier, looking at the historic timeline of everything in the S&P. It is far more likely you're going to land somewhere in this intermediate section for what's going to happen in the future. It is very unlikely that there's going to be no movement in the index forever, or only negative movement. So you'll probably end up somewhere with this growth of cash value and this growth of death benefit. So if nothing happens at age 65, you'd still have $103,000 guaranteed to you, but you could have $145,000. You could have $198,000. That's cash value. We're not even talking about the $363,000 of death benefit that there could be right there. Okay, that's a nice page to talk through. And then again, there's more of these that you can break down with a tabular detail and go over same things. I like to show for, and Nicole, you can stop me if there's anything on these pages that you love to show with your clients. This goes year by year. So you can, if they're talking or planning for a specific trip, a specific year, we can work through that and take a look at what they would have at that point in time for cash value. All right. So the statement of policy cost and benefit, again, this is another way of breaking down all of the costs associated. Like I said, a lot of pages of this policy, right, guys? Okay, so the dividend and paid up additional detail. So this is nice. It's going to be an overview too. So as you can see, the first year, there's not going to be any sort of cash value built up quite yet. But it's a nice glance at over time what you can expect to happen based on the dividends. Any questions popping in there, Nicole? Going kind of fast on these parts. Yeah. Lots of pages, lots of pages. All right. So this is what I wanna point out to you, obviously says for agent use only. The input summary is really, it exists for you to be able to recreate this illustration should you need to. So when I first started out, guys, I was a little bit uncomfortable with the system, especially with like the new IUL when that first came out. So when you're not comfortable, you can lean on your product support specialists and have them help you put some things together. So you could come to them with the notes you had for Stephen, if that was your client, and say, here's what I know about the client, here's what our life insurance number is, and here's what our goals are. Can you please help me put together, a perm term split or, whatever policy it is you're going to do there, to make some recommendations for this client. And let's say that they go ahead and they do that, and they send that illustration to you and offer to talk through it with you. At the end of that, you're going to have this input summary that you can then see everything that they did to build out this policy. So you can then recreate it yourself. All right. Same thing for if you are working with another client and you want to recreate what you did for a different client, but just change a few things that would make sense. I'm sorry, did you lose me?
I lost you for a moment.
Okay.
Raising your hand. Or her hand,
Yes.
sorry. That's easy.
Can we go back by chance to that, screen with the intermediate and current? Can you explain that a little bit? I don't know if I'm the only one that kind of glossed over that, but that was kind of fast.
Sure. Was it the tabular intermediate current or the breakdown? Like these things?
Back, go further,
Well, there's trying to think, way up here, there's the beginning one. This one?
maybe.
No. I think you're thinking of these right here.
Yeah, so that, so. So what do you, I guess I'm just a little bit lost, maybe it's just me,
No, you're fine.
explain this a little bit to me, what is
What
intermediate?
we're looking at?
Yeah.
Yeah. Okay, so, this is year one of his policy. So he's, turning 30 years old this year. His contract is for, $3,000 a year. These are his guaranteed values right here. Everything on this side of the guaranteed. So this is, everything that we're building into the policy. So guaranteed year one, there's no cash value. By year 5, it jumps 5 years here. There's some cash value built in. So we can see over time, year 20, year 30, where his cash value lies. And this is all guaranteed. So his guaranteed death benefit, his guaranteed cash value for those times. But what's cool and what's actually more likely, Stacy, is that he's going to really end up somewhere over here. So the guarantee is, let's just go back to year 20. So he's 49 years old in year 20 of this policy. His guarantee is that his cash value is going to be $40,798. Okay. But what I like to show is that although this is guaranteed, it's actually more likely to end up somewhere here in the intermediate column at the $52,000 of cash value. And the reason being goes back to the dividend. We have allocated 100% into his dividend feature rider that we have. So over time, year after year, when the index, like the stock market, does well, or does poorly, right? If it does poorly, you just take the guarantee. But if it does well, then you would have growth and higher dividends year over year. So over time, it's far more likely that he's going to land somewhere closer to this $52,000 of cash value in year 20 of this policy. And we see that when we look at the historical page we went over a little bit ago, going over the last 20 years of the S&P index performance, where we can see it's just not realistic to say that the index is never going to have a positive return again. We have to assume there's going to be ebbs and flows, up years and down years over time, and that there is going to be some growth within the market. But we never lose the guarantee. So this is how I'm sorry.
Oh, and then the current is what this currently was at the time this was done.
Yep, so if the policy is paid out as the index is currently performing, this is truly what would be paid out at that time. So back to year 20, then they would truly have 65,000 of cash value built in if it's performing exactly as it's performing today in the index. That's why I always lean towards the intermediate, because it's going to be somewhere in the middle. It's not going to be, I never want to, like I said, I like to under promise, over deliver. I want to set up the expectations from the very beginning. So it's not realistic to assume we're never going to have an up year again in the market. There's going to be up years and down years. So I like to point them closer to this. It's going to fall somewhere between here where they're going to perform and what they can expect their death benefit to be based on what we put in to their policy. Yeah.
Yeah, I was just gonna kind of help explain that a little bit different, so
Please.
the guarantees, right, like Kim said, that's gonna be bare minimum if the stock market crashes and does not perform at all, you're still gonna get that. The current, like you said, let's say it's performing over the last 20 years at an average of, say, 6%, just using hypotheticals. But the intermediate, if you use other carriers other than, like if you have brokerage, a lot of times they will actually say certain percentages. So they'll say current is 6%, the intermediate might be if it performs at 3%. So it's just to kind of gauge it somewhere in between the two, like she said, but a lot of times it's just different percentages based off that performance.
Thank you so much for explaining that. Any other questions, you guys? All right, Nicole, I think I can stop sharing and we can go back to the slideshow. If that works for you. Yeah. Well, I hope that was beneficial, you guys, based on, I know that those illustrations are long and lengthy and full of stuff. I just kind of wanted to show you the things that I highlight and what I would be talking about with them. And I'm sure you'll find your own groove on that. And you could also lead into your district leader on what they would have you do with your client. But I cannot emphasize enough the fact that we could work with our product support people. They are here to support you. And I use them time and again to help me be the expert and create these illustrations.
And any final questions regarding the illustration before we move into our case studies? Going with? Going to? All right. So what's going to happen now is, or half of you are going to stay in the main room with Kim, and you'll be working on case study A. The second half will go into a breakout room with me. So we will be working in groups for about 10 minutes. And at the end of 10 minutes, the breakout room will close and we will come back together and share our findings and our responses. So I'm going to upload the document. I'm sorry. Uploading case study A for the people staying in the room. If you can open it, please give me a thumbs up reaction on the document in the chat box. Awesome. A lot of you guys can open it. All right, so in each case study, it's going to have a completed your life insurance number, and it also gives you the underwriting results. Now, when we are in our groups, those who are staying in the main room and in the breakout room with me, I want you to address these questions. So what type of insurance would work best for the clients? What additional options might also be applicable? And what sales or tools would you use when working with the particular client? And when we come back together, pick a spokesperson for your group to represent your findings, to report those out to the other two. All right, any questions on that before I release us all? Okay, I'm gonna go ahead and release the groups. Give me just one moment.
Natasha.
Okay. See here. Are we still all together, Nicole?
Yeah, I'm about to join second room.
Oh, gotcha.
If you wanna advance to case study A, I'm gonna pop in with the second group to address their questions.
Perfect. Will do. Thank you, ma'am. All right, so here's our case study, and I'm gonna give us about 10 minutes to work through the questions. Again, the type, the options, and the tools. So at the end of this, we're gonna ask again for somebody, not me, to speak up on behalf of the group on, you know, some of our takeaways and what we want to do. So although I'm here, I'm not meant to like run this. This is still your guys' session to go through. So read through for the first couple of minutes, and then maybe I'll ask a couple of questions to prompt you guys to talk through what you're thinking. One thing I'll point out for you guys is on the income part. You'll see the larger numbers, 265 and 235. That is not to say that Cameron earns $265,000 a year. That's to say that he earns, he wants half of his income for 10 years. So you see those parentheses? That's going to be what you're looking at here. So he wants $53,000 of income replaced. Sorry, he wants half of $53,000 of income replaced for 10 years. So he makes 53 a year, but he only wants half of that replaced for 10 years. And that's where we came up with 265 as his full number. So I just didn't want you to think that Cameron and Tasha are just loaded, and you might go, well, why do they even need insurance? All right, any idea of what type of policy would work best for his clients? Tasha and Cameron?
I'm thinking like a term policy.
Okay.
But I'm still learning all this stuff on here, so that's about all I know for now.
Type budget call out there. That's a great entry level, you know, type of policy to start with, because that's going to be the best way to get the most death benefit for the least premium in the term policy. So it's a great entry level on there. Anyone thinking of different options or riders they might want to put on to this family's recommendations?
I don't recall, can you do the spousal rider on a term policy or is that just a permanent plan?
You know, good question. I believe that's just for the permanent plans, but now I'm thinking about it. Maybe you can.
I was just
Let
thinking,
me,
because Tasha's table rated to a primary policy on Cameron and get a spousal rider.
yeah. Yeah, let me look that up for you. Vicky, are you listening? Would you help me look that up on this one to see if we can do a spouse rider on a term policy? I think that we can actually. But I cannot remember. Certainly a child term rider, right? You've got the ages 5 and 7. A child term rider would be a really affordable way of adding in some coverage and some options for those children as they age. Remember when I went through the illustration a second ago, that waiver of premium, that disability waiver of premium only added about $13 of premium per month to that policy that we were looking at. So one thing that I'm thinking about for this family where they're already very concerned on a tight budget on premiums, that might be really attractive to them if they have any concern of Cameron or Tasha getting injured and still having to pay these premiums while not being able to work. So having the disability waiver of premium might be an attractive rider to recommend for them. What kind of tools are we thinking that we might use? Have you guys seen the term life rate book comparison? Being able to compare or have a nice overview of all that term options available based on the person. Highly recommend that. When we drop the link at the end of the session, again, for the Level Up Life page, I believe you'll be able to find all of those things there. But the term life rate comparison, it creates a really nice document that you can share with the client that's going to give them, based on, a certain underwriting result there, right? Choice non-tobacco, table B, they're going to be able to see where they land for a 20-year term versus a 30-year term, with return of premium added or not, kind of thing. Hey, Stephen, are you recording me right now? I can't hear you. I think you're on mute. You're on mute, Stephen. I can't see that either. I'm sorry. Why don't you just Teams message me? Can you Teams me? I would say that be careful with recording. I'm pretty certain I'm not allowed to record these sessions, and I would be, okay, you're just trying to, I can't see what you're saying. Just message me in the side. Maybe you were. So good. Sometimes these breakout rooms do something funky to our ability, our audio and our microphone. So I'm wondering if Steven's having issues being able to come up with mute.
Kim, I have a question as well.
Yeah.
When we do the policies through country directly and not brokerage, do we have the option down the road to do a rate modification? If, let's say, you know, it is table B, but it's because of, you know, whatever reasoning, we can, you know, whether it's a year down the road or, you know, a couple of years down the road that has improved, we can do a rate reduction.
Definitely, yep, they call it like a rate reconsideration. So I would work with your underwriter to discuss that, but that can certainly happen. And I've
Lots of that.
had. Hello,
I know you can do it with, tobacco.
yes. Yes,
So would any of that be prorated back?
sure.
On that guaranteed insurance rider. If they're the preferred plus, when they do that guarantee, they move it, I guess after the term's over. Do they automatically get the premium plus? Or would it be just choice, not tobacco?
You know, I don't know the answer to that, Nicole. I think that, with the guarantee insurance option, they'll, you know, let's just say you put a GIO on the policy for $100,000. You would have 8 times throughout your life where you could elect for another $100,000 or up to that without having to prove any, insurability. So no medical requirements or jump through. But as far as the rate at that time, I'm not certain if
It
they'll-
transfers over.
Right. It does transfer over, okay.
So no
So I
matter,
guess-
no matter what, if they're lost their leg, whatever, they would still get the preferred plus or choice, whatever they were rated at the time of the initial application. That's good to know.
All right, since we are back, our group did fairly well. I'm very proud of the work that they did for case study Bs, but since the main room was on case study A, Kim, do you have the spokesperson for group A to report out your findings and recommendations?
Well, I had mentioned that it won't be me, but we didn't have to get to who it will be. So I'm not certain on who wants to give a few thoughts there. I know that Jimmy had a couple ideas during ours, so maybe Jimmy, if you don't mind talking about what you were thinking through for Cameron and Tasha.
I was just thinking term and like Andrew mentioned too, like the spouse rider and then using the tools to level up and using the support team in my DL to help me on that because this is something really new for me. So
Yeah. And Nicole, will you remind me on a term policy plan, you can still add a spouse rider to that policy, or is that only on a whole life plan that you could write a spouse rider?
I really don't remember. I have to go in and look at it.
Yeah, I'm fairly confident that you can, but my brain, I don't want it to be certain, so I'm gonna look that up in a moment.
Well, we'll circle back to it. I'm gonna try to look right now.
So, thank you guys. Any highlights from case study B that you want to point out before we move forward? Spokesperson?
So case study B, our spokesperson was Ari. Ari, would you please come up and mute and report to group A our findings and what you guys determined?
Hello, so we determined that we were going to do a firm term split, PWC5 with GIO, and we're going to desire premium to match their budget.
Awesome. Firm term split for the win. I love that.
They also decided to allocate 100% of the dividend options.
Smart. Smart plan there. Yeah, very cool. Sydney and Taylor. Look at them. Did you guys talk through the income not being $375 a year for Sydney, but really the smaller amounts in the parentheses next to it?
The determination was made based off of the total your life insurance number, and so based off of their affordability and how things would change. They said that they could convert later on if they chose to get more as their income changes.
Cool. Awesome job. All right. Any questions on these case studies today, you guys? Putting some thought behind our recommendations? Have you learned anything? Will anybody be calling upon the product specialists to help them out with these illustrations as they begin? I certainly did. Product team is awesome. Vincent, any thoughts?
Yeah, I was gonna say, yeah, I'm through I haven't even finished, going through the online settings for this, so yeah, I picked up a lot today, just hearing it, so me not being as interactive, it's really just me sitting here trying to absorb as much as I can before I go back and go ahead and finish everything else on this.
Mhm.
Yeah, no worries. I'm glad to hear it. Glad you're kind of picking up on, I think it's really just the concept of looking at this at first glance, like what the heck is going on here? But when you start to think through, all right, this is their debt, this is their income. Like it's really just helping them identify what's their number and then how can we help them put some ideas behind what would make the most sense for their life insurance program, Megan, oh, sorry, Christy, and then Megan.
So I was just curious, cause like, yeah, I'm not feeling overly confident about like term, no big deal, but like all these other whole life and the universal and all that. Like, so what is the time period for somebody to get really like efficient, confident with that? I mean, what are we looking at?
Unfortunately, there is no magic formula to say, all right, Christy, and month 7, you're gonna feel really confident in this. I think it's just really how much you're in it, how often you're making these recommendations and going through it, where your confidence is gonna grow, that you are making, you're gonna be comfortable in the system, comfortable making these recommendations, having that conversation, especially with these permanent products where there is a lot of bells and whistles. It's very intricate. That's why I always do recommend and remind you that you have a bunch of experts on the back line here to support you. From underwriting to those product specialists and support team, they're all here to help you be the expert and have everything that you need to win. So I would just say that continue to lean in and, if you haven't ever heard of the product support specialist yet, there is a whole team devoted to our products, and especially in the life space, our life product team are very knowledgeable and they can sit down with you. I used to have Teams calls like this, right, with a product support specialist, and I would ask them, hey, can you go through this IUL illustration with me and help me understand what I'm looking at? Because it's a completely foreign language to me. And they would just we just carve out 30 minutes here and there where we would walk through it before I met with my client. So when I got with my client, I felt like I was confident in what I was about to deliver. And so it just might take you some time until you find that aha moment of like, I feel good about this. But you'll always be learning. And things will change and you'll learn something new again. Megan, we're next.
This one was just food for thought. Adam actually brought the question up, for the index. If you have, a family like this case study be, if you ask them if they want a budget, you can ask them how much they're comfortable with spending a month and term split it there, instead of just being a straight term. So I thought that was a really good add-on to that, of different kind of options where you can still wrap a lot into that.
Absolutely. I like Andrew's comment in here too, kind of doing the term and permanent plan, going through that. I'll get to Nicole here in a second. My only other thought on that is when we first started out, I was taught to do a good, better, best, right? So I would always do, here's a term policy for 20, 30 years on what you could do for the lowest, possible premium wise, based on your budget and stuff. Here's a whole life, the Cadillac, of what you could do. That would also accomplish this, and here's what that would cost, and what comes with it. And then here's a nice middle ground, right? The middle one was always what I really wanted them to take. And it was like more of a combination of both, right? It would have the base policy. So they'd start to get that cash value, maybe a more affordable version of a permanent policy. That would have that chronic illness rider tagged into it, the IDF. But it would also have the higher death benefit attached to a 20 or 30 term rider, to where, it kept the premium in a reasonable place, but still accomplished their life insurance number. So good, better, best, kind of showing them a spread. And that's not always going to be the right way, but it's a good way, especially starting out, helping people decipher what would make the most sense for them. Nicole, what would you say?
So I was just gonna circle back to the question that was posed earlier in regard to the spousal term. That's only available on whole life insurance, because and I put the image in there under the quoting system. So if you select just term insurance, the riders that are available are the return of premium rider, the waiver of premium, and the child term. The spouse is gonna only be available on the whole life policies. Something else that came up in our room was ROP, because they wanted to do a perm term split. When you select the option to do a perm term split, you have to select the whole life insurance option in order to get that breakdown as appropriate. You can put in the base amount and should solve and put in the premium that they're comfortable with, and it'll solve and break down those percentages. If you can't add an ROP on that whole life policy, you would have to write a completely separate one and a separate whole life if you wanted to do that. So you'd have two separate life policies. One would be strictly the life, and one would be their term with that ROP rider.
Okay, good call there. I would also say that I have a return of premium, but ROP she's talking about. I have a term policy with a return of premium that I wrote on myself, probably about 5 years ago. And what I love about that policy too, and why I'm an advocate for the ROP, is that when I don't die, right, hoping I don't die by the end of this term policy, I will have all of the premiums I paid into it back to me, or available back to me, in one big lump sum that I could then take back. Or I could then convert all or part into a reduced paid up whole life policy at that point in time, without having to do any sort of medical requirements then either. So I really think that the return of premium is a fantastic product that we offer. So if you haven't explored that much, I would lean in with your district leader and ask more questions about that, because I think it's a really great solution for a lot of families too. So that's my 2-bit as we finish this out in our case study today.
Everyone give yourselves a round of applause. You all did amazing on this activity.
Yes, really appreciate you. All right. So we already did this, sorry. You may have heard of Country Club already, but we are in the end of your 3rd week of the rep training. So I wanted just to highlight it one more time, that this is going to be a sort of great feather in your cap should you be going for the Country Club bonus. It's your first way to win here at Country. And as you move through your career, you'll hear more about the All-American and the All-Star. And those trips are fantastic. I can attest to that. So you'll want to be doing what you can to earn those as well. But whatever you do not be one of those that miss out on the perk because you have not written a life policy. So with Country Club, have to have written at least one life policy, right, Nicole? So I hope you would do at least 5 life policies, but at the very least, try to get one in there, at least on yourself, on a relative, something in there. Even if you're just doing a simplified one, again, simplified, I think is less than 100,000. As long as you're under the age of 50, it's got to be that choice standard rate. Can't get it preferred on the simplified, but there's check out the qualifications for that. But that could be an easy way of getting your life policy. I have seen people have fantastic numbers for Country Club where they should have and could have been the best in Country Club, but they just didn't have that one life policy. So doesn't matter if you've got 55th, you don't even have one life policy in the mix. You have to have one life policy in order to earn Country Club. And that will come with a very hefty bonus of $2,500 just for qualifying. Okay, so look around you, reminder, your peers that started on the same date as you, those are the ones you're going with for Country Club. Thank you, Nicole. She put the information on the Country Club contest in the chat for you, so you can see first place, second place, third place, and the entire qualifying bonus there. And each week on Tuesdays for managers, your district leaders, the RVPs will all get the standings, where you stand for Country Club. So hopefully that motivates you to challenge yourself. These first few months, just hit the ground running, be hungry to chase productivity and some dollars in your pocket. All right, so speaking of challenging ourselves, let's go ahead and highlight some resources. Thank you, Nicole, for dropping this into the chat for us as well. But I want to make sure that you know, again, go to Level Up, save it as a favorite, have not yet done this, okay? The Life Sales Approach Guide contains a lot of education that we've talked through today, a lot of content to help you with your life sales approach, okay? While you're out there, look at that Getting Started guide here for your sales approach. And between these two, you should be able to find all of the links today that we've referenced. Like earlier, I was talking about for the life policy suite trackers, we talked about the growth insurance number, we've talked about the term comparison. I was talking about that with my group earlier in the breakout. That term comparison is really fantastic to use when you're selling insurance as well. All righty. Any questions for us on your research?